Vanguard has the best ETFs in the industry, in my opinion. And today, we are going to go through the 6 best Vanguard ETFs that are out there. Now, when it comes to ETF investing, I always suggest buying and holding for as long as possible because ETFs are long-term investments, meaning these are things you should not be buying in and out of or day trading. Instead, ETFs, you should be buying and holding for the long term. So buy and hold as long as possible if you're interested in investing in ETFs. And for those who don't know, an ETF is a way for you to buy a basket of stocks that mirrors something like an index. So say, for example, you buy an S&P 500 ETF, what you are buying is an ETF that is mirroring the index. And the only main difference between an index fund is that an ETF trades like a stock and an index fund trades like a mutual fund. There are other minor differences like tax implications and things along those lines, but the major one is how they actually trade. All right, so let's dive into the ETFs. The first one is going to be VOO, and VOO is the best ETF that Vanguard has for mirroring the S&P 500. And if you don't know what the S&P 500 is, it is the index that tracks the 500 largest stocks in the US stock market. And in fact, it's actually a little over 500. It's about 508 stocks inside of the US stock market. VOO is one of the best ETFs out there. I've held it for years and years, and it is one of my favorite ETFs in the entire world. In fact, if I made a list of my top 5 ETFs, VOO would definitely be on that list. Now, let's look at some of the key metrics when it comes to VOO. So when you look at VOO, you can see some of these key stats. The first one is that expense ratio. It's got a very low expense ratio at 0.03%. You want to keep your expenses when investing as low as you possibly can, and ETFs are a major factor in helping you do that. VOO has some of the lowest expense ratio in the industry at 0.03%, because the last thing you want to do is give away your hard-earned dollars to advisors or mutual fund fees that are going to take a large portion of that growth over time. Even a 1% fee has massive implications over the lifetime of your investment portfolio, so you got to make sure that you keep those fees low. The next thing we're going to be looking at is the turnover ratio. That turnover ratio is 2%, which is extremely low on VOO. If you look at ETFs that trade more like a mutual fund, you'll see some out there with a much higher turnover ratio. Anything above 50% is way too high. But the turnover ratio, when you keep it low, that means they are buying and selling less stocks inside of that fund. And the key to this is that means you're paying lower taxes the lower that turnover ratio is, which is very powerful. And the dividend yield here is 1.64% on VOO, which is a strong dividend yield for an ETF when it's not a dividend forward fund. Now let's look at the top 10 holdings of this fund. So we have all companies that you've heard of in the S&P 500. It's the top companies in the world typically. So it's Apple, Microsoft, Amazon, Nvidia, Tesla, Berkshire Hathaway, which is Warren Buffett's company, Alphabet Class A, which is Google, Alphabet Class C, which is Google C-Class shares, ExxonMobil, and United Healthcare Group. Now, the thing to note with these is that the top 10 holdings will always change. So if you're watching this video in the future, make sure you check out those top 10 holdings. The beautiful thing about holding ETFs, if a top 10 company is struggling, they're going to kick that company out and add a new company. And as you can see, those top 10 holdings are almost 25% of this entire portfolio. Now let's look at the total return over the last few years. So over the last 1 year, we're recording this in a bear market, is a negative 11.59%. Over the last 3 years, it's 18.42%. Over the last 5 years, 10.69%. And over the last 10 years, 11.99%. So if you're looking for an S&P 500 ETF, VOO is one of the best out there. And if you get 11.99% over the long term, that'd be absolutely amazing. I would expect somewhere between 7 to 10% is where the S&P 500 typically lands historically. All right, number 2 is if you're invested in getting some real estate exposure, then VNQ or Vanguard's real estate ETF is the fund. So this is a ETF that invests in REITs or real estate investment trust, and it follows and tracks performance of the MSCI US Investable Market Real Estate 2550 Index. What that means is it follows REITs and other real estate investments inside of this fund. Now, let's look at some of the key stats on this one because the expense ratio is 0.12%, which is a much higher expense ratio than VOO was. It's still a very low expense ratio compared to most funds, but it is a higher expense ratio in comparison to some of these broad market ETFs. And the turnover ratio is also slightly higher, but still a much lower turnover ratio at 7%. But here is the key when you're investing in something like this, is the dividend yield, because it has a very high dividend yield of 4.21%. Now, when you're holding something like this, an ETF with a dividend yield like this, you want to make sure that you keep that in inside of something like a Roth IRA, because those dividends are going to be taxed at a much higher rate. So you want to keep them in something like a Roth IRA where you can get that tax-free growth inside of that money. Now let's look at the top 10 holdings here. So the top 10 holdings are going to be Vanguard's Real Estate Index. We've got Prologis at 7.75%, American Tower Corporation at 6.27%, Equinix at 4.33%, Crown Castle Incorporated is at 3.85%, Public Storage, yes, the storage unit company, is at 3.21%, Realty Income, which is one of the most popular REITs out there because they pay their dividends monthly if you own that. That ticker symbol's O, is 2.73%. Simon Property Group is 2.64%. Then we have Welltower Inc. at 2.3% and Digital Realty Trust at 1.94%. Now let's look at the total returns over this time frame, because typically these will not appreciate as much as something like the S&P 500 will. So over the last years, negative 24.35%. Short-term returns don't bother us as long-term investors. Over the last 3 years, 8.47%. Over the last 5 years, 5.06%. Over the last 10 years, 5.41%. And over the last 15 years, 6.05%. So your appreciation on this isn't going to be as high, but you're hoping to get that dividend yield and live off that income if you're investing in something like this. Number 3 is maybe my favorite ETF of all time. It is VTI, and VTI is Vanguard's total stock market ETF. And why I love VTI is you're investing in every single stock inside of the US stock market. So you are owning thousands of different stocks within this one ETF. So you are really well diversified. In addition, you're also getting the benefits of being invested in a bunch of different market sectors as well. So the expense ratio on this one is 0.03%, the same exact expense ratio as VOO. In addition, the dividend yield is 1.62%, and the turnover ratio is extremely low, a little higher than VOO, only because there's more stocks inside of this fund, but it's a 3% turnover ratio. Now the weights here you're going to see on the top 10 holdings are going to be very similar to the S&P 500, and it's going to be Apple at 5.6%, Microsoft at 4.7%, Amazon at 2%, Tesla at 1.4%, Nvidia at 1.3%, Alphabet 1.1%, ExxonMobil 1.1%, and United Healthcare Group 1.12%. Now a lot of people are going to ask, well, can you invest in VTI and VOO at the same time? And the key to knowing if you want to do this is you can use something like the fund overlap tool. So there is an ETF fund overlap tool. We will link it up down below that we've talked about before. What is the overlap between these two funds? And you could put in something like VOO and VTI. And when you look at that fund overlap tool, you'll see, is this too much overlap for me? Is it redundant for me as I go through this process? Now let's look at the historic returns when it comes to having VTI in place. So for the total return over the last 1 year, it's been negative 12.7%. We're recording this in a bear market. Over the last 3 years, it's been 18.16%, 5 years, 9.91%, 10 years, 11.45%, and 15 years, 9.83%. So VTI, amazingly well diversified, one of the best funds that are out there. Number 4 is VGT. Now VGT, if you don't know what that is, it is Vanguard's tech ETF, one of the best ETFs out there, and it is one of the best high growth ETFs. In the last 10 years, it is the best performer on this list. So VGT coming into play is going to be investing in a bunch of different tech stocks. No surprise there. Tech stocks have done very well over the last 10 years. The expense ratio on this one is 10%. The dividend yield is much lower than all the other ones we've talked about at 0.79%. The reason for that is that tech companies don't pay a very high dividend yield typically. So it's typically older companies that pay a higher dividend yield that have been along for a long period of time, because these tech companies think they can deploy that capital for more growth instead of giving it back to the investor. So that's why that happens. Turnover ratio is at 6% on this one as well. Now, when we look at the top 10 holdings, we are looking at Apple, Microsoft, Nvidia, Visa, MasterCard, Broadcom, Cisco Systems, Salesforce, which is a new one added in there, Texas Instruments, yeah, your TI-83 calculator. Remember that from high school? So these are all companies that are inside the top 10 holdings when you look at VGT. Now let's look at the performance, because this is a very high performer over the last 10 to 15 years, and you're going to see why here in a second. It's actually absolutely amazing how well this has performed. So over the last 3 years, 22.78%. Over the last 5 years, 18.22%. Over the last 10 years, 19.14%. And over the last 15 years is 15.44%. Compare that to something like VTI over the last 15 years, 9.83%. You're looking at over 5% returns. And if you look at something like VOO over the last 10 years, is 11.99%. So this is a really well-performing ETF, one of the best out there, to be honest. And it's one that really is in the tech sector. So as you can think through this, what is going to be happening in the future of tech, artificial intelligence, these types of things are not going anywhere. So this is something where it is a great fund to own. Now, if you are a dividend investor and you are interested in investing in dividend stocks, we talked about the REIT fund earlier. here, but VIG is one that is a fantastic dividend ETF if you're looking to buy a dividend ETF. Now, what VIG does is it tracks the performance of the S&P and the US Dividend Growers Index, and this is one that you want to have a little bit of a higher dividend yield when you invest in this fund, and we'll look at some of the returns here as well. But the expense ratio of VIG is 0.06%, and the dividend yield is 1.99%. But here's the key, and this is one I don't like, is the turnover ratio is 26%. It's a much higher turnover ratio in comparison, and the dividend yield is not much higher than VOO and VTI, but it is one that historically can have higher returns, and it has a higher dividend yield when you look at the performance here. So United Healthcare Group is number one on that list, and it's 3.7%. Microsoft is 3.5%. JP Morgan Chase, which is Chase Bank, is 3.5%. Johnson & Johnson, dividend stock staple, 3.3%. Visa, 2.9%. Procter & Gamble, another dividend aristocrat, 2.7%. Home Depot, 2.5%. MasterCard, 2.5%. Broadcom, 2%. And Pepsi, 1.9%. But let's look at the total returns on this one, because if it has a higher dividend yield and is giving us nice returns, this might be an option for you. So the last year, negative 6.33%. So as you can see, some of these other funds have had worse returns in down markets, where this has a less worse return in a down market at negative 6.33%. But you look at the 3-year returns, 16.33%. Last 5 years, 10.5%. 10 years, 10.9%. And 15 years, 9.5%. So a great fund to look into if you're looking for a dividend performer. Now, the last one we're going to look at is a large cap ETF, and this is VUG. And when you look at VUG, this tracks the large cap growth index, and it's going to be one that has fantastic performance as well. So this is going to be similar to investing in like the NASDAQ 100 when you invest in something like VUG. So the expense ratio on this one is 0.04, turnover ratio very low, 5%, and the dividend yield is much lower at 0.67%. And the top 10 companies are all, again, companies that you have heard of before: Apple, Microsoft, Amazon, Tesla, Nvidia, Google, Visa, MasterCard, Home Depot are all on the list for the top 10 holdings. And the top 10 holdings, the difference here is you can see that pie chart there. That pie chart shows the top 10 holdings are a much larger weight. Why? Because this has less stocks inside of the fund. If you're looking at 100 stocks in that NASDAQ 100, less stocks are in this fund, and they hold closer to 40 to 50% when you have this fund in your portfolio. Now, over the last year, negative 17.25% returns. Why I like showing these negative returns is so you can see how volatile these funds are, and I'm glad we're recording this in a bear market so you can see this across all these funds. Last 3 years though, 17.24%. Last 5 years, 12.31%. 10 years, 13.31%. Incredible. And last 15 years, 11.35%. So this is a fantastic fund. Going to have some of the 100 largest companies inside of the US stock market inside of this fund as well. So listen, I hope you guys learned a ton about my top 6 favorite Vanguard ETFs. If you guys have any questions, make sure you leave them down in the comments below, and don't forget to like, subscribe, hit that notification bell, and we will see ya on the next video.